Welcome to Sales Accelerators, Winning Strategies for Financial Professionals, an educational webinar series that explores the latest tools and concepts to help boost your sales performance and drive business growth. Join us as we analyze trending topics in life insurance, investigate the latest headlines, and discuss solutions to accommodate your clients' unique needs. Please welcome your host, Kurt Fasen, Executive Vice President of Sales and Marketing.
Hello, welcome everyone to another edition of Sales Accelerators. My name's Kurt Fasen. I'll be your host. I'm Executive Vice President here at DBS. And today we're going to be talking about the recently enacted HR1. Well, a lot of people call it the big, beautiful bill. And the point today is for you to help you understand the implications of this bill and really how it's going to change planning strategies. Of course, to help me tackle this, I'm pleased to bring back once again my good friend Terri Getman, DBS's Vice President of Advanced Markets, who has been a guest many times in the program. With her vast experience in the industry, she's going to break it down for us. Terri, good to see you again.
Great being here, Kurt.
So before we get started, before I get you going, Terri, to kind of walk through it, folks, you got something called a webinar action plan. Webinar action plan. You can see it here on the screen, and this is to help you to think about clients you should be talking to as Terri's walking through the different provisions of the bill. So as we're going through it, make some notes, and then after the program's over, you and your regional sales director from DBS can sit down and talk about maybe next steps and bring Terri in as a resource, of course. All right, well, let's get started. Enough of all the housekeeping stuff. One big, beautiful bill signed into law July 4th, 2025. Terri, let's start with an overview.
Yeah, they always ruin my holiday vacations. I think they planned this. I think the best way to understand the bill is actually in reference to the 2017 Tax Cut and Jobs Act. As you might recall, in the Tax Cut and Jobs Act, about the only thing that was major interest that was made permanent was the 21% corporate tax bracket. Everything else was temporary, and that temporary was set to sunset or expire at the end of this year. What the bill did was to make many of those temporary provisions permanent. And so I've got a list here of about 7 main ones that I thought our financial advisors would be interested in. First, that it made permanent the 7 tier income tax brackets. At one point, President Trump did come out about increasing the bracket to the 39.6, but that did not happen. So we have the 10% to the 37% bracket with an additional inflation year for cost of living increase for the 10, 12, and 22% bracket. Second, it permanently repealed the personal exemptions, but to offset that, it made permanent the doubling of the standard deductions that we've all become used to. Fourth, I should say, it permanently eliminated the miscellaneous itemized deduction. That was the 2% itemized deduction, which unfortunately for financial advisors, that's where their financial planning fees, their investment fees were deductible by individuals. I know Fonseca is working hard to try to bring something back on that to encourage people to plan. So more on that in the future. It also permanently repealed the P's limitation on itemized deductions. This was kind of an overall cap to itemized deductions. It did, however, replace it with something a little bit different for only the 37% tax bracket. And then finally, the one that most people were looking at least in the financial services industry, I think, was it made permanent the increased and high estate tax exemption amount. So those are some of the big ones.
Well, that's a good overview. And as you were going through each one of those, I could see how that could have, impactful implications for clients, right? But I guess the one that I was watching the closest, you pointed out, the number 7 is the estate tax exemption. Maybe you can just take a minute and share with us how the provisions of the bill will impact really the estate tax landscape, and then really germane to what we do here at DBS and those that are watching this webcast or listening to the podcast, how does that impact life insurance and estate planning?
Well, the bill made permanent the high exemption and actually increased it. As you know, this next year we were expecting the exemption amount to drop in half, so around 7 million-ish, somewhat. Instead, what we will have is a 15 million exemption, 30 million for a couple. That is probably slightly higher than the 14 whatever cost of living amount that we would currently looking at. So basically that means fewer estates again are going to be subject to federal estate tax. Now, I did do a little bit of research and found for the last time that we saw any type of reporting, which is 2021, we had approximately 6,500 individuals file federal estate tax returns, of which only around 2,500 of those were taxable. So you can see that this focus on estate tax liquidity, the need is becoming increasingly less every year. But I think what's important to note, and certainly this is one thing that I've been looking at and calling financial advisors on, is this is the first Republican trifecta or even Congress where we did not see repeal of estate taxes.
Right.
I think the last time that happened might have been the senior Bush, because Junior Bush President Bush ran on a platform of repealing the estate taxes. So that's 20 plus years ago, 30 years ago. So that in my mind is significant.
Well, I think it is. And, from the planning that I get involved in with our advisors, maybe some of you that are on, and I know Terri gets involved in, one thing this does do is it provides clarity. How many times, Terri, did you and I hear from an advisor or from an advisor's attorney or a family office saying, well, we just don't have clarity. We're going to wait. We're just going to wait and see what happens. But are you saying with this now number, 15 million per person, 30 million per couple, does that mean that estate planning with life insurance is essentially dead? Is that how you're interpreting this?
I chuckle every time that's brought up, and I put up with that even in law school. My focus was on tax and estate planning, and I think estate planning has died at least 4 times since 1982. Yet I'm still doing the same thing, Kurt. No, it doesn't mean estate planning is dead, because there's still a lot of other opportunities beyond estate taxes for life insurance. First of all, we need to remind ourselves there's still a few states out there that have state death taxes. We're sitting in one, Minnesota. I do want to give a shout out to those in Washington State. They recently had a revision of their state death taxes. The exemption amount was increased from 2.193 to 3 million. But at the other end, their rate increased to 35%. That is like, oh my gosh. They're definitely aiming for some of those technology billionaires in that particular state. That is huge. So we still have, state death taxes, from a tax perspective to look at. We also have other things that I tend to look at, because estate planning really is about making certain that what you have goes to the people that you want at the time and manner that you want. And taxes are kind of like, oh, by the way, they're the last thing. So we have things like, a lot of people I work with have large IRD qualified plan accounts where there's income taxation that is going to be a consideration. In fact, we may see because of the higher exemption, more people own, continuing to hold on to those assets. You get into things like charitable planning, special needs planning. There are more and more individuals being identified, with limitations in the area of special needs. And then, of course, in my mind, the big one is business succession planning. That consumes a lot of my time, actually.
I think that's right, because they don't call it estate tax planning. They call it estate planning. And estate is everything you own. And like you said so eloquently, it's making sure that the money gets to where you want it to get to in the manner you wish it to get there. But you brought up business succession planning. Let's dig into that just a little bit more. Are there implications from the bill regarding business succession planning that we should be aware of?
There are, and there would be a couple. One is kind of indirect, and that is, you might recall last year we had the Connolly decision by the Supreme Court.
Right.
And the increased exemption kind of indirectly affects, the holding of Connolly. Connolly basically said that if you had business-owned life insurance, that the liability created by the buy-sell agreement in an entity purchase arrangement is not the kind of liability that reduces the impact of the life insurance. And so consequently, when you have a business entity purchase buy-sell arrangement, you include the value of the life insurance on top of the other business assets, inflating the value of the business and thus increasing the impact of estate taxes. And so, indirectly, when we were looking at a 7 million, there would have been more people that would have been impacted by the Connolly decision than they are at 15 million. But I'll have to tell you that even with that increased exemption, what I'm finding, it's really my number one opportunity, is simply asking business owners, do you have any business-owned life insurance? It's amazing the mistakes that are occurring in that genre. I have seen buy-sell agreements where you have business, well, not the agreement, but the insurance, where the business is the owner and we have co-shareholders as beneficiaries of policies. I've had situations where business-owned insurance have not filed their employer-owned life insurance, the 101J form. So that makes the life insurance subject to income taxation. And so all of those issues are being drummed up, frankly, by the Connolly decision. And frankly, you're seeing a lot of attorneys and CPAs that are still focusing on Connolly because, what Clarence Thomas said in Connolly was your solution is a cross-purchase arrangement. And, the attorneys and CPAs would tell you, well, frankly, in a cross-purchase arrangement, since it's a purchase of a co-business owner, they get a step-up basis for that purchase price. Right. Whereas if you do an entity arrangement where the business is purchasing the interest of the decedent, the surviving owners do not get a basis increase under that particular business structure. And so it's giving them a little bit more reasons to go out to business owners and, review their life insurance. So it's a huge opportunity, and it really can be, you can open up the door with one simple question. Do you own any business-owned life insurance? And if the answer is yes, come to us.
Let me just ask a question there, Terri. Sorry to interrupt, but as I'm hearing you talk about that, back to those of you that are listening and watching, if you have business owners that you just wrote down on your sheet, right? And you ask them, do you have any, what Terri said, do you have any business-owned life insurance? Terri and the rest of the DBS team, your regional sales director, we will look at that, right? Yeah. We will help you analyze it. We don't expect that you don't dwell on this every single day. We do. So get it to us. We'll look at it. And then, as you just heard Terri articulate, we'll take a look at it and say, yeah, it's in great shape. Or, there's a couple things here you're going to have to take a look at and just be aware of. I assume you'd agree. I mean, that's what you spend a lot of your time doing, right, Terri?
Exactly. You know, I do this every day. Let me do some of the heavy lifting for you. All you have to do is ask a simple question and identify the opportunity. That's it.
For sure, for sure. You said there were two. What's the
Yep.
second one?
The second one is an interesting section of the Internal Revenue Code. Section 1202 of the Internal Revenue Code deals with a C corporation having the ability to exclude gain on the sale of its stock. It's qualified small business stock. For a business owner to qualify for this exemption, the business has to be small, which historically has been under 50 million. Now it's 75. So we got more businesses potentially qualifying. And in addition, the exclusion was increased from 10 million to 15 million. And so now it still has the 10 times your investment in the business limitation, your basis in the business. So, you know, we have potentially more businesses that are going to qualify under that exclusion of gain on the sale of the business. In addition, they added, it used to be you had to own the stock for at least 5 years, be able to qualify for the exclusion of 100% of the gain. Now, somebody who owns the stock just for 3 years can have a partial exclusion of 50%. And so I think the objective here were to get some of those investors out there actively involved in, and if it's 4 years, it's 75, is to get those investors involved with helping small businesses, you know, providing investment, seed money, whatever, into businesses with the idea that within a short period of time, they don't have to hold on to it for 5 years. They can realize a profit. So I think this will actually spur, you know, small business development. I think that certainly what is a priority of the current administration. It will also impact choice of entity. Because if you have, you know, people who are serial entrepreneurs, and I certainly have met several of those over my lifetime working in this area, where they buy a business, develop it, grow it, and then sell it, and then on to the next business. I had just the other day, I was talking to two people, and one was planning on retiring, or at least selling the business at 45, and the other one was 50. I'm like, oh my gosh, folks, you know, what are you going to do after that? Start another business, you know? So we're going to probably see, you know, more activity in that area. So the question then boils down to, with that exclusion only applying to C corporations, a lot of the businesses that I deal with are S corporations or LLCs, taxed as S corporations. Will we see the C corporation selected as an entity of choice? Now, that is more of a legal, you know, accounting type questions. But what I want to bring to light is if you've got business owners that are electing C corporation, there's a whole lot more opportunities from the insurance design with a C corporation than there is with an S corporation, because now we're looking at two separate taxpayers. So we now can look at things like deferred comp arrangements for even the business owner. We can look at some of the hybrid long-term care, you know, possibility, the exclusion of the long-term care from income for those C corporate owners, where we have the age-based limitations for S corporate owners. So they could really open up some opportunity from the insurance side with that becoming more of a focus for the legal and accounting community on selection of entity type.
You know, I think that's great, and I like hearing that the bill is going to really, if you will, spur or encourage those people that are the serial entrepreneurs to continue to do that, and they aren't being penalized to hang out 5 years. But you brought up entity type, and you know, you've got S corps, LLCs, sole proprietorships, partnerships. Just take that group, and then let's go back to the 199A QBI deduction. What happened with that whole deal?
Yeah, you might recall when it came out of the House, I believe we were looking at a 23% deduction, the provision being made permanent. It then went into the Senate, and of course, part of the Senate was concerned about obviously some of the deficit impact on deficit, and this obviously every dollar that was going to be used to avoid taxes for small business owners is obviously an increase on the deficit. So they moved it down to 20%, and made it permanent as opposed to having it disappear. They also added a few tweaks in this area as well. They expanded the phase out range. So we've got more small business owners able to take some form of the QBI 20% deduction. They also made a minimum deduction amount for individuals that have a business or series of business where they're earning at least $1,000 of qualified business income. They will be able to receive at least a minimum $400 deduction.
Okay. Let's switch gears. Let's move away from businesses for a moment, and let's talk about personal income taxes to be specific. And as I was watching, and you and I spend a little bit of time watching what's going on in DC, you more than me, but both of us do some of that. And there was a lot of disagreement, I recall, between the House and the Senate over the SALT deduction. So maybe you could just talk about what's included in the SALT deduction and then what finally passed with this bill.
Yeah, SALT stands for state and local tax deduction. And the taxes that they're referring to are state income taxes, state property taxes, and then finally your sales taxes, which can include things like cars, boats, those types of things.
Yep.
Obviously, since we are focusing on state taxes, the states that we're most interested in this are high tax states. So that also explained the difference between the House and the Senate in this particular position. The Senate does not have any senators from high tax states, so they were less concerned about it. On the other hand, we have a very slim margin in the House, made up of 4 representatives from the states of New York and California, 2 high tax states. And so in order to get the bill approved at the House level, the Senate had to at least give some deference to Representative Johnson and his membership in order to be able to get ultimately the bill passed and signed by President Trump. And so initially, the House had placed the SALT deduction at $40,000 cap as opposed to the $10,000 cap, which is where it is at today. The Senate put $10,000 in as a placeholder, and there was a lot of discussion going back and forth between the House and Senate. And finally, they came up with a $40,000 cap, but made it temporary.
Okay.
And
until when? What does temporary mean, Terry?
Temporary means until 2030.
Okay.
So it will be 40,000 starting this year, 40,400 next year, and then it will increase by 1% until 2029. And then on 2030, it will go back to $10,000. The other item that, and again, there's a phase out for high income tax earners, those over $500,000 of modified adjusted gross income, where the amount will phase down, the cap phases down, but will not be lower than the $10,000 that it is today. And the Senate also added some provisions that are workarounds for some of the states that have workaround capabilities for them to be able to take state deductions on their state income tax returns. And in this, the one area that I'm starting to hear a lot of opportunities actually deals with establishing trusts as one avenue of being able to qualify for multiple caps.
I think this is very important because when you think about it, as these caps, temporary or not, it will free up income for these folks to be able to use for planning techniques, and be able to be more flexible in some of the things they're doing. When you go back to the presidential campaign, it didn't matter which station you were listening to. The presidential campaign, we heard both sides talking about no tax on tips, no tax on overtime, no tax on Social Security. Again, what happened, and how will this impact the income for those folks that are impacted by this?
Yeah. Well, we did have all of them. We do have some provisions in the bill for no tax on tips and no tax on overtime. We have actually have a provision that provides a temporary ability to not have tax on qualifying tips up to $25,000. And qualifying, they're looking at things typically that people have generated tips, such as bartenders, restaurants, hairdressers, those types of things. For overtime, the cap, temporary cap, is $12,000. That can be eliminated from taxation. Again, this amount is reduced for high income earners. Here, high income earner is $150,000 of income. And what I thought was really interesting, it's for 4 years.
Right.
Starting this year, 2025 through 2028. Just happens to be the election cycle, right?
Yeah.
For the no tax on Social Security, they had to use a different approach. This bill was actually approved using the reconciliation process, and the reconciliation process prohibits the ability to address Social Security under that process. So what they did was add a new standard deduction for people over age 65, includes me. This year, starting this year, each individual over age 65 will be able to receive an additional $6,000 deduction. For a couple, that's $12,000. This is on top of the current deduction that we have for being over age 65. So again, this is only for 4 years. From this year to 2028, and then I guess we're going to have to revisit all of these provisions in the next presidential election to find out what's going to happen there.
Well, right. I mean, so in HR 1, or the big beautiful bill, some of the things were permanently changed, and some things that went through were temporarily changed, more linked to the election cycle. But even in these temporary changes, it is allowing people that are impacted more income in their pocket, which then leads to more opportunities to do planning. So in the end, I think it's very positive. I was reading through the bill, and a couple, not to the degree you do, of course, Terry, but I was reading through some of the highlights of the bill. And the one thing that caught my eye was this thing called the Trump account, something for kids. So what is that all about? And what should advisors be aware of?
Yeah, it started out as the mega account
Yeah.
and got changed to the Trump account in the process. What this is a new type of account that's kind of akin to a Roth IRA. And it's set up for children under the age of 18, where an amount up to $5,000 can be contributed to this Trump account. It is an after-tax investment, so like a Roth, you do not get a deduction for putting money into it. The money can come from parents, grandparents, employers even, although the employer contribution is limited to $2,500. The money that the employer would put into the account is tax-free to the individual, so that's kind of nice. The contributions, the money stays in the account. It cannot be touched at all until the individual reaches age 18. And then at age 18, the gain is taxed as ordinary income. Now, during the process, initially the account was structured to be used only for things like higher education, the first-time home mortgage purchase, and setting up a business. But that was eliminated in the process. So now at 18, it can be used for any purpose. And originally, the distribution was going to be, if the distribution was after 18, it was going to be taxed as capital gains. That also got lost in the process as well. It's now ordinary income. So it's going to be interesting to see this account, how long it lasts, how it fares versus some of the other types of accounts that are available, like the 529 account.
Right.
We also have a pilot program, which I find really interesting. For those individuals, those children born in the United States between January of this year, January 1 of 2025, to 12/31, December 31st of 2028, again, 4 years, there is a one-time deposit of $1,000 into one of these accounts by the U.S. government. It's a credit. Parents or legal guardians can set up the account, but if they don't, the Treasury is going to set it up for you. That's going to be really interesting to see how this works out.
Yeah, I think there's more questions than answers for the Trump account at this point, but really a lot of this stuff's going to start taking place right a year from enactment, right? So it won't be anything people are going to do
Contributions
immediately.
can't be made until July 4th of next year.
Right. So between now and then, stay tuned. DBS, for those of you who can work with annuities and things like that, we have an annuity division, and there are other things that you can use to help fund these. But stay tuned. We'll have more information as that one becomes more clear, I guess, in the future. So Terri, in your opinion, what's the most significant planning consideration that advisors that are joining us today, they really need to be aware of in the wake of the enactment of this bill?
Well, I know a lot of our financial advisors do a lot in the investment area. And certainly Roth conversions have been, a main topic of theirs for many years, partly because they were concerned about the increasing tax rates. Well, now that the tax rates have been made permanent, again, the ability to make Roth conversions at low tax rates, we still have this looming deficit, out there, which were really notorious in the United States, putting those types of things off, I guess. Eventually, I think that Piper is going to pay the price, and we're probably going to be looking at higher tax rates at some point in time. I do need to remind you, permanent means permanent as long as we have the current congressional makeup, right? Who knows what the next, in 4 years or even 2 years might happen. So certainly Roth conversions is going to continue to be an opportunity. For the last couple of weeks, Kurt, I've been keeping names of people that said, I'm waiting to decide on the estate tax. So I've been following up with advisors on, remember that person that you said that was waiting? You might want to go back and tell them, good news, there's still an estate tax. Because I think a lot of those people that were waiting, especially the very well-to-do individuals, were hoping that we have a trifecta. They're going to eliminate the estate taxes. I mean, certainly that has been the topic since the Bush era. So that did not happen. So going back and talking about the estate liquidity, but again, a large percent of those, 35% of all taxable states are business owners. And so there's a huge opportunity, especially for estate liquidity. In fact, Kurt said the case that we're working on right now, business owners are notorious for wanting to plow money back into their business. And nobody likes paying for insurance premiums. But at some point in time, you've got to go from growing the business to protecting the business. And, most business owners don't want the government in their business, and your only option with the 6166 is having the government in your business. So going back to those taxable estates, many of them business owners, bringing up the need for liquidity is extremely important. The expansion of the 1202 C corporation area, I think is going to be a big focus, frankly, in the legal and CPA community on selection of business entities. And I think we'll see more businesses electing the C corporate structure, which then leads us into things like hybrid life long-term care options and deferred comp sales. Even my favorite, split dollar, is going to be more prevalent, executive benefit type arrangements. And finally, in those states that have high taxes, California, New York, Minnesota is up there, Massachusetts. In fact, Minnesota now beats Massachusetts in taxes, I believe. The workarounds that we're going to be seeing in the SALT, the non-grantor trusts. We've talked about grantor trusts for years, and some of the estate planning benefits of grantor trusts. Now we're going to start seeing some of the benefits from an income tax standpoint in the area on the non-grantor trust. So more to come as we start digging into some of these provisions, and of course we're likely to see a few more changes coming down the pipe, which of course since they basically used up the reconciliation for this year, we'll have to be able to pass on a bipartisan basis in both houses. But come next year, we again have the ability to use the reconciliation process, and we'll be interested to see how it's going to be used next year before we have, an election cycle coming in.
Yeah, great recap. So just so I heard them correctly, Roth conversions, right? Roth conversions are big, and those can actually drive into a pathway of income or revenue that can be turned into life insurance to help with estate planning, helping people understand that the estate tax is now permanent, no longer needing to wait. Business owners taking advantage of the expansion of 1202. And then finally, the SALT, having more opportunities around SALT and non-grantor trusts. I think if people have questions, which they probably will, they need to reach out to us. And, we went through a lot of information that can really impact your clients. And don't forget, you have obviously the resources here at DBS to help you. We have our regional sales directors across the country. Here you can see a map of where they're located. We have our case design team, as well, obviously, as Terri, right here to help you on your cases. They're on the phone, they're ready to help whenever you need help. The common thread here is have the conversation, have the discussion with your clients, and make sure they're taking advantage of HR 1, also known as the Big Beautiful Bill. All right, Terri, any final words for our guests today?
Nope. I think, over the next several months, much smarter minds than mine will be out there talking about opportunities. I'm there actively listening to those people, and we'll be sharing them as they crop up.
Absolutely. Well, hey, Terri, thank you for joining again. As always, lovely to have you as a guest again. And thank you to each one of you. Thank you for taking time out of your busy schedule for joining us for another edition of Sales Accelerators. At DBS, we're thankful for your business, and we look forward to seeing you again real soon. Until next time, take care, be well, be safe, everyone.